Before you fill out your next credit card application, stop. Because these 5 things can get you auto-denied for your next application, even if your credit score is solid and even if your income looks good on paper. I've helped thousands of people get approved for top-tier credit cards, and I keep seeing these same 5 mistakes over and over again. But it's all completely preventable if you know how to speak to the bank's algorithms. This isn't about some TikTok hacks or loopholes. It's about knowing exactly what not to write so you never get denied again. By the end of this video, you will get approved for the credit cards that you actually want rather than just settling for whatever will accept you. So let's break down the 5 things to never write on a credit card application, starting with the 1 mistake that silently flags you as high risk, even if you never miss a single payment. The first thing that will lower your approval odds faster than anything else is putting down self-employed or retired in the employment section. I know, it sounds crazy, especially if you actually are self-employed or retired, but here's what's happening on the back end. About 80% or more credit card applications are handled through automated computer systems. The remaining 20% either have red flags or need verification. When that algorithm sees self-employed, it immediately flags them as high risk. In the computer's mind, self-employed means that you have unpredictable income. It thinks that you might have good money one month and nothing the next month. The same thing with retired. The algorithm assumes that you're living on a fixed income, probably Social Security, and you might not be able to handle additional debt payments. But here's the hack that changes everything. If you're self-employed, you're really not self-employed. You're employed by your business. Even if you are a sole proprietor, even if it's just you could put down that you work for your business. Don't have a formal business name? Then create one. Something simple like Johnson's Consulting or Smith Marketing Solutions. The algorithm doesn't care what your business is called, it just wants to see that you have an employer. And if you retire but still have some kind of income, maybe you do some consulting, maybe you have rental properties, maybe you do gig jobs, you can list that down as your employment. For instance, my dad is fully retired, but he still does DoorDash on the side since he gets bored at home. He can put down this company as his employer even though he is retired. The goal is to show stable, ongoing income from a recognizable source. That's what gets you past the first screening. But employment status is just the beginning because what you put down for your income can make or break your entire application. This second point is where I see people mess up consistently and costing them thousands of dollars in credit limits. Most people make one of these 2 mistakes. They either put down way too little because they're miscalculating how much they really make, or they put down some crazy high number thinking it will help their chances. Both approaches can give you bad results. Here's what most people don't understand. Credit card companies are asking for your gross income and not your net income. That's before taxes, before deductions, before anything comes out. So if you made $70,000 last year, but you projected to make $100,000 this year, you can put down $100,000. This rule specifically allows for income that you can reasonably expect to earn. I'm not making this stuff up either, because most if not all credit card applications tell you that you can do this in the fine print. Also, if you're over 21 and regularly use your income from other people to pay for your bills, you can include that too. This is for my younger adults that still live at home and working to get their life together. You can factor in that amount of help that you receive into your income. Same goes for your spouse's income. You can include it. Pretty much any money that regularly flows into your household, you can count on it. And here's a pro tip. If you have any non-taxable income like VA disability benefits, you can actually increase that amount by 25% when reporting your gross income. The IRS allows that because non-taxable income is worth more than taxable income. Now here's where people go wrong on the other end, inflating their income in hopes of better odds of approval or higher starting limits. Now, income is all relative to where you live. It might be more common to find a family that makes $500,000 in New York City compared to a family making $500,000 in the middle of Iowa. Usually anything over $500,000 might trigger a manual review or a financial review later down the road. And when humans get involved, then they start asking for proof like tax returns, bank statements, pay stubs. You really don't want to deal with that hassle. Stated income is often exaggerated. However, your credit report can suggest whether your stated income is believable and might influence your approval. For instance, if you claim to make $250,000 a year, but recently took out a small auto loan for $14,000 over a 7-year term, that raises a red flag. Any other negative information on your credit report, such as late payments or persistent high credit card balances, could make them question about your high stated income. The sweet spot is putting down income that makes sense for your situation and your existing debts. But income is just part of the equation and is just oftenly used for your starting credit limits. The third point is crucial, especially if you're a renter, because your debt to income ratio is a huge factor when it comes to credit limits as well. Here's what most people don't understand about housing payments on credit applications. When it comes to rent, the majority of the time, it's not reported to the credit bureaus. That's why so many credit card applications ask whether or not you own, you rent, or have some other living situation. If you own your home, they usually can't see your mortgage on your credit report when they pull it. So they already know that debt and can factor it into your debt to income ratio along with any other debts that you might have. But when it comes to rent, this is typically just self-reported, just like your income. This works off the honor system. I never met anyone or seen any data points where lenders actually request lease agreements or anything like that. The only card that might ask for this is the Bilt MasterCard, but that's really just to verify your rent so you can get points for paying it. Here's where most people mess up. Overstating your rent makes your expenses seem higher than they actually are, which can hurt your chances of approval. For instance, let's just say that the actual portion of your rent is $700, but you report the full $1,400 rent that you share with a roommate. You just double your housing costs on paper, making it look like you're completely overextended financially. And here's something that I'm sure that most of you already know, but I need to say it anyway. Do not factor in any other housing costs that go into your monthly expenses. Don't include any utility bills, maintenance costs, or anything aside from the actual housing payment. So the fix here is to report only actual housing costs. If you live with your family and pay no rent, then just put down 0. If you split rent or a mortgage with somebody else, then just list your portion. By keeping your housing costs realistic, you give lenders an accurate picture of your financial situation and avoid unnecessary denials. This fourth point is huge, especially if you are applying for business credit cards. When they ask you what you use your credit for or what type of business that you're in, you need to be very careful about your answer. Certain industries are automatic red flags for banks. Real estate investing, cryptocurrency, cannabis, credit repair, adult entertainment, gambling. These will get you denied faster than anything else. I do not care if you're the most successful real estate investor in your city. The moment that you mention real estate investing on a credit card application, it's going to be much harder to get approved automatically and may require a manual review. Every business has an NAICS code. It stands for North American Industry Classification System. It is basically a 6-digit number that tells a lender what type of business that you run. Every legit business has one. Lenders use your NAICS code to assess how risky your business is. You can find the full list of high-risk businesses linked down below. If you are a high-risk business, focus on the mainstream low-risk parts of what you do. If you're a real estate investor, maybe you do some real estate consulting, so put that down instead. Remember, you're not lying. You're just emphasizing the parts of your business that banks are comfortable with. But even if you nail the first 4 points, the next mistake can still destroy your chances. Here's something that people should do, but they don't. Most people apply for credit cards without even knowing what's on their own credit report. That is like walking to a job interview without knowing what's on your resume. You're setting yourself up for failure. Here's what happens. You apply for a card, everything looks good, then you get denied. Something was on your credit report that you didn't even know was there. Maybe it was an old account that you forgot about, maybe a late payment from 2 years ago, maybe you left a high credit balance on an account that you forgot to pay off. You need to pull your credit reports from all 3 bureaus before you apply for anything. TransUnion, Equifax, and Experian. You want to look at everything. Your personal information, your account history, your payment history. Make sure that your name is spelled the same way everywhere. Make sure that your address is current, and make sure that there are no surprises waiting for you. If you find negative items that shouldn't be there, then you really need to dispute them before applying for new credit. This is where tools like Credit Rehab Pro can be incredibly helpful for identifying and removing inaccurate information quickly. If there are discrepancies between these reports, then it can trigger a manual review or automatic denial. Everything needs to line up perfectly for those instant approvals that we all love to see. So take the time to clean up your credit profile before applying. There's a difference between getting approved instantly or waiting for weeks for a decision that might still be a no. I have created plenty of videos on my channel about DIY credit repair, so check them out after this video if you are in this situation. Before we wrap up, let me give you a few bonus tips that can make a difference between an approval and a denial. First, most people don't realize that every credit card issuer has their own set of rules and approval criteria. Even if your credit card is excellent, you can still get denied if you don't meet their specific requirements. For example, Chase has a rule that automatically denies you if you open too many accounts recently, while Capital One limits how often you can get a new card. These rules are in place because issuers are trying to manage risks. They want to make sure that they are lending to the right people. Second, start with banks where you already have relationships. If you have a checking account somewhere, then apply for the credit cards first. Existing customers usually get preferred treatment. Third, consider starting with secure cards if you are new or rebuilding credit. They are much easier to get approved for and can help you establish positive payment history. And fourth, pay attention to the credit requirements for each card. I also recommend using a pre-qualified tool if the lender has one so you can gauge your odds. If you don't know which card to get next, you can use my card finder tool, which will give you recommendations based on your credit profile with only a soft pull. The link is down in the description. But here's something that I didn't mention at the beginning of this video. Everything that I just shared with you won't matter if you have serious negative items dragging down your credit score. And these items can be costing you thousands of dollars in higher interest and denied applications. If you want to learn about a powerful tool that can help you identify and remove these items automatically, then click on this video right here. I'll see you in the next one.